Oh, yeah. Hey, we got a Fed meeting. Yep. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus in the long term. Never risk money you cannot afford to lose. We're just a minute. We're just a minute or so away. Let me move things out of the way. We just finished our quarterly outlook, and we are just a couple of minutes away from the Fed not changing interest rates.
Gold price falls as U.S.-China tariff talks ease tensions. Fed in focus.
The fiscal hawks are fighting back on the budget bill. Federal Reserve expected to keep interest rate unchanged. Powell's remarks eyed for next move. Swiss market ends nearly 1% down. Binance founder CZ predicts Bitcoin could hit peak between 500K, 1 million, or as institutional adoption grows. MUFG. Even a hawkish Powell today may not lift the dollar. Major European markets close on weak note after cautious session.
Gold price forecast. Gold U.S. dollar consolidates ahead of Federal Reserve's decision.
U.S. Farm Secretary says new dietary guidelines coming hopefully in early fall.
Dow Jones Industrial Average holds steady ahead of Fed rate call.
Coolio, less than a minute away. Less than a minute away. What are they gonna do? What you gonna do? Ten, nine, eight, seven, six, 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 five, 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 five. What are they gonna do? What are they gonna do? Yeah, we're not expecting anything, but it's the press conference that'll be very interesting, huh? Oh, for sure.
I think that's a great point. And of course, we can't pretend like the Fed's making this decision, in a vacuum. They're making it up against some serious pressure from the president. So how that factors into things, we're about to find out. Let's get to Steve Leisman for the Fed's decision on interest rates.
The Federal Reserve keeping interest rates unchanged at 4.25% to 4.5%. But seeing a higher chance of stagflation. They didn't use that word, but here's the language they did use. They said the risk of higher inflation and higher unemployment have risen, both of those together in the same sentence. They went on to say a further increase in uncertainty around the outlook, adding that word further to the prior statement. Also noting that swings in exports have affected the data. That's why we got to that big negative GDP number, and they took note of that for the first quarter. But saying economic activity still continued at a solid pace. The unemployment rate is stabilized at a low level, and that inflation remains somewhat elevated. So all of that basically in line with our understanding of the hard data. They say they are watching risks on both sides of the mandate. The decision was indeed unanimous. Quantitative tightening will continue, and the committee is prepared to adjust monetary policy as appropriate, which is a language that they've used in other times. Guys, this notion of the risk of both higher inflation and higher unemployment have risen. It really underscores that idea of there being risks to both sides of the mandate, and the Fed apparently being no closer to figure out which one needs more careful attention from the Fed yet. Kelly?
Okay. All right. Very interesting. Very interesting. Let's go to the Fed Watch tool. And we want to keep an eye on this changing. So yesterday, this was at 68.8. Today, it's at 71. And over a course of the next few hours and next few days, this is likely to change. Again, it was 71, so remember that. Well, it's stuck nonetheless. You want to see if this is going to change. If this drops, no, sorry, if this rises, then these things are falling, and that very often creates dollar strength. Take a look at our short-term indice. Okay, dollar weak, dollar weak, dollar weak. That's the initial response. Take a look at some of the major currencies.
The full statement from the May 2025 FOMC rate decision.
Breaking. Fed leaves policy rate unchanged at 4.25% to 4% as expected. U.S. President Trump, no to pulling back on tariffs on China. United States Fed interest rate decision meets expectations, 4%.
FOMC decision, rates unchanged as expected.
Okay, down to the moving average, down to next week's pivot. So far, this week's swing was perfect. Boom to boom. Now the thing is, will there be a re-up or a collapse? Is that a double top? Well, you'd need some serious dollar strength for that. And for understanding the dollar strength, you want to see this rising. Hasn't been updated yet. It'll update over time. USD kitty cut, stuck in the mud. Euro dollar. Okay, our bottom is that daily 21. So up is favored. I would trap and break this if I were me. That kind of thing. That's what the price action is saying. It's really going to come down to what Powell says during that press conference. Theta says no cuts till winter. Well, I just did the annual outlook and we were talking about, not winter, but a different time frame. Skippity says, yeah, Skippity Scalpity. Yeah, press conference is where the party's going to be. Yeah, without a doubt. I want to go back to the global stock indices. Well, let's start with U.S. stocks and then global stocks. Yep. Fed's, they're talking like the Fed doesn't want to save us. Jim, it should already be there. But I got to move it from one spot to another, I guess, is what it is. Do I? Oh, second quarter uploaded recording. Probably do it now. What I'm saying. Okay, it's published. Let's take a look. Uh, there it is. Because they're going to wait until you can't buy anything and then they're going to save us. Cool. There it is. Of course, you can watch it faster. That's what they're telling us. So anyway, that particular year with tariffs and Fed raising interest rates, we had a lot. And you can
U.S. dollar index drops after Fed maintains rates and warns on economic risks. Breaking. Fed leaves policy rate unchanged at 4.25%, 4.5% as forecast.
A comparison of the March 2025 statement to the May 2025 statement. Cool. Right on. So anyways, whoa. S&P 500 not loving it. Fed's not going to save us soon. Also, too many people had June priced in as a cut, but I discussed that an hour and a half ago. Yeah. Hey, have you clicked the thumbs up button yet? Or is that too much to ask? Oh, hey, have you clicked the thumbs up button yet? Or is that too much to ask? Cool, that's not too much of a delay. Yeah, it was definitely hawkish and not dovish, right? That goes without saying. We wanted a little more dovishness. Take a look at our NASI. Let's go farther out. So we're up on the trend line. And we're very toppish for sure. So bears could have their field day here. Yeah. The next buying zone is down here around 119. 19,300, 19,250 maybe. Okay. Really not much, but now we're kind of trapped almost like a triangle. If you're going to use the moving average as a dynamic level of support, yeah. Oh, right on, Liam. Let's take a look. Oh, I forgot to make an announcement today. Um, Irregardless of your membership at traders.com, at one point, people subscribed for scalping team or technical team or fundamental team or pro, which includes everybody, right? Yeah. Yeah, everything, right? You guys remember all that? So if you are on the scalping team, the technical team, or the fundamental team, I unlock the entire website for you. No need to change your membership. No need to upgrade. No need to pay more money. I just unlocked it about 3 hours ago. So now you have access to the entire site. You have access to the sentiment, which includes the squawk,
Euro.
includes the vol, includes scalping, includes implied volatility, and includes sentiment. Includes fundamentals. Get all that data. Crazy. Includes the technicals. So we can look for patterns in the stock indices. Yeah, nothing looks good now. Everything's down, down, down. Includes the performance coaching. Dude. So thank you for being a subscriber. So again, if you signed up for scalping only or fundamentals only or day trading only, I've unlocked the entire website, including the sentiment tab for you. Compliments of the firm. You don't need to do anything. You don't need to pay more. You don't have to change your subscription. It's just unlocked for everybody. Yep. We also have a rebate and a prop firm too.
Euro US dollar jumps despite Fed rate hold as markets still see cut in July.
Trump says he isn't open to lowering China tariffs to get them to the negotiating table. Now let's look at technicals. Thank you, David. Thank you. I only laugh like giving away things for free. Yeah, it's a good thing. More is better. Right? That's, as they say, more is more. Yeah. More is more, everybody. All right. What do the stock indices look like? You want to just do US? Okay, let's just do US. I gotcha. ASX off. DAX off. FTSE off. Nikkei off. Dow, NASDAQ, S&P 500 on. Okay, down, sideways, sideways, sideways. A rising wedge, but with a down leg, so that's a threat to anything good. And a threat to the uptrend. So, yep. It was 2 hours ago, Derek. This is the recording. Which sucks. Huh? Because that could kill, I don't know, it wouldn't be good for sorghum prices, I guess. I don't know. They were late raising and then, all that kind of stuff. Do you think they'd, well, now we got a complicated question because, well, Trump's like, dude, I'm doing tariffs, cut interest rates. Obviously. So you'd only want to be a senator if you could rape and pillage. Great horse liberated the world and the first seal was broken. Well, the economy's about to tank, but then the Fed steps in and saves us. This is what's happened. Opinion, it doesn't matter. We need to figure out, it's not about Wayne. It's not about you. It's not even about us. It's about the entire aggregate of the global financial system. So we need to figure out what everyone else is going to do. It's nice to know before they know, but we can't go an hour and 45 minutes. Anyway, so there you go. Yeah, we covered it in great detail. We reviewed. Oh, it's down here. Sorry. Okay. Yeah. So we already had that. It's already uploaded. Cool. Okay. Derek BLL, well, hell, rocks for anthrax. How's the crypto world doing? Whoa, look how easy that is. Bitcoin, that says down. Whoa, what? Yeah. That's on the 30-minute. On a 4-hour, sort of a dipsy and then up through 100. Forex. Let's just look at dollar pairs. Dollar, 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 and dollar. And we're trying to look for congruency here. Dollar strength or dollar weakness. So notice much of these patterns were the ones that existed before the fundamental release. So you want to, just as important is the potential pattern here. Remember, the way to trade this, it's not a buy signal. What it's saying is if it goes up, then there's probably a new pattern that looks more like that. So it's more like if it breaks out, look for a dip. But that's probably not how it's playing out. So a lower low will predict a lower high, and you would probably take that as your new trend in the future. So you want to look for that. So this came out 36 minutes ago before the news. 36 minutes ago, there was more like, right, this consolidation was potentially this way. Is that still true? It may not be. So if this is popping up, okay, maybe that's changed in that, because these are emerging patterns that have not formed yet. So if they fail, that's informative information. Okay. So if we ride this moving average, then yeah. So that's why you want to pay attention. So a lot of these are going into this Fed meeting in consolidation. USD yen was bullish. Is it still? We don't know. Aussie USD on a 30-minute was bearish, but approaching an apex. U.S. stocks move lower after Fed decision. Yields lower.
U.S. dollar yen dumps after Fed warns of rising economic risks.
So like Rand, for example, is showing some risk off here. Now, it's a down channel. Yep. But the next leg of the down channel is up. So you could use a couple of different things if you were going to continue with that theme. Now, the theme might have changed, but the theme is to sell it off the top. Okay? And you get a scenario like like that. Now, a different plan, same thing but different, okay? You use this area. And that creates a plan like that. So even though it's, let's say, rising now, if you are still in a belief of USDs are down, and I would only sell it, I would never buy it, even if I thought it was going up. So there's an opportunity to sell it at like 18.5-ish and take it down, because up would be out of the long-term position. Just because, let's say, it's rising now doesn't mean it will continue to rise. Okay? In particular with the press conference coming up. This sets up a very interesting opportunity for us here on oil, okay, where suddenly an inverse head and shoulders is in play. Yep, that's interesting, isn't it? Anybody think that this is at least 50% possible? Anybody? 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 Then let me show you how to play it. Have the machine do all the work for you. What? Yeah. So you go, this is how you, one way to use TRADARS. You say, go to commodities. Okay. Go to commodities, only watch oil. Suppose you can do Brent as well. They're going to be related. But nah, let's just do USD. So you're saying, okay, you think you might get a inverse head and shoulders off of the annual projected low. The annual projected low. So it's not just a random price. It's an inverse head and shoulders at a projected low. So now you say, okay, TRADARS, show me reversal patterns and trending patterns on WTI, because you're interested in buying it. Do you buy this? No. Now we're watching on the daily. This is a daily. 4-hour, 1 hour, 30 minutes, and the 15-minute chart. And we're looking for either reversal patterns or trend patterns. Now, you can have a trend pattern that's down. You can have a trend pattern that is sideways. That's one variation. There's, obviously a range, a total range, which would be like this. Okay. Or it could be an uptrend, right? And we want to look at this on 5 different time frames. So, and we only want the most reliable, repeatable patterns of sideways or up. So, is this an up? No. Okay. Is this a sideways? No. So we don't do anything right now. Now this is on a daily. So why is there no 4-hour, 1 hour, 30-minute, or 15-minute reversal patterns or trend patterns? Because we're looking at all those charts right now, and those patterns do not exist. There's no Gartley's, there's no head and shoulders or inverse head and shoulders, all that kind of stuff on any time frame. So now you can just keep going back to this, and then suddenly you might see something that looks bullish. That's when you go long, in particular on a small time frame. Or you get some Gartley type thing, and it's measuring all kinds of and all it's telling you is up. How do you know? Well, if you look at this angle and this angle and this angle and whatever, dude. Okay, but it it'll notice the Gartley. You don't have. So if I let's find an example. So, um, like this is something I wouldn't notice myself. These other things for sure. This 3-drive merging. Would I notice this? No, I probably wouldn't. ABCD, I do kind of a different ABCD. So those are things that I wouldn't have noticed. Doesn't mean they don't exist. Tesla, Nvidia, look at that. Lots of weight on these things. I'm just trying to see if we can find a nice little Gartley somewhere.
Dow Jones Industrial Average stumbles after cautious Fed rate hold. Gold price slips as Fed holds rates, warns of heightened inflation. Australian dollar, US dollar steady at 0.6545 as Fed fails to shift rate cut expectations.
Just looking for, in particular, a Gartley. I just want to show you a Gartley. And they may not exist. So this is me burning through hundreds and hundreds of charts looking for a Gartley, and it just takes me a few minutes or even moments. A lot of these 3-drive waves. Okay. Yeah, look at this. I'm just burning through hundreds of charts because there's more charts that you don't see than the charts that you see. And the don't see is also. I'm not really into that Sky Killer. Again, that's not really that type of pattern. I usually see something else. All right, here's sort of a Gartley. Again, I wouldn't have noticed this. Yeah, I definitely would not have noticed this. But it makes sense. What does this chart say? Up, down, or sideways? Is this going to make a higher high or a higher low according to this chart? Only Jim is confident enough, strong enough to risk his neck. Okay, lower low, lower high, higher low, higher high, lower low, lower high, lower low. Whoa! Wah. Oh, what? Ooh. Yeah. Sorry. Now that's just a pattern. It's not a prediction. Oh, we got the meeting? All right. Thank you. Thank you. I appreciate that. Let me pull up the main source and then an alternative.
Solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run
Very
objective.
quiet, huh?
In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. After briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter.
I'm going to try to
Net
get this
domestic foreign
louder.
purchases, or
It's always
PDFP,
quiet.
which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal.
Pound U.S. dollar slides as Fed holds rates, flags rising inflation, growth uncertainty.
Jerome Powell comments on policy outlook
Hey,
after
Zach,
policy rate
fine minute.
unchanged at 4.25%, 4.5%. Watch live. Powell holds a press conference following the May 7th FOMC rate decision.
Explainer. Oh my God, it's so loud. How does U.S. food safety work and what cuts has Trump made? Fed leaves interest rates unchanged, warns of higher unemployment, inflation. Trying to find it.
These policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases
All right, turn the
in
squawk
tariffs,
off.
That have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level.
Short-lived.
It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look at where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick Timmerose of the Wall Street Journal. Chair Powell, there's naturally a lot of anxiety around 2021 with the flash shocks. But there are some who argue that the current situation has notable differences. Energy costs are down. Housing imbalances look nothing like they did 4 years ago. Labor demand appears to be gradually cooling, with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by about where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So go through 2024 up to the day. We've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times, but the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now, and we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very long time, so again, difficult judgment to make, and not one that we face today, and we may never face it, but we have to be keeping it in our thinking now.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
It's going to depend. I think you have to just take a step back and realize this is why we are where we are. We're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't. And we just don't know. Until we know more about how this is going to settle out and what the economic implications are for employment, for inflation, I couldn't confidently say that I know what the appropriate path will be.
So following on that, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're not really in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also there are things that can happen that will that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that. But in the meantime, yes, we're watching it extremely carefully, like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we, of course, tapered and everything. And then we immediately went into QT, and, we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential, and we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not on your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way, but that's not at all what we meant. So that's just not a correct reading of our. But I can see how maybe people found that confusing, and we have to take that into consideration.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses, big and small, are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there would be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time, and and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. People are not layoffs, or people are not getting laid off at high levels. Initial claims for unemployment are not increasing, in any kind of impressive way. So the economy itself is still, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that, in March, there was guidance that 2 cuts might happen. 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. And we don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we had the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the two goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. I think you know what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
We don't give Congress fiscal advice. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path, and it's on Congress to figure out how to get us back on a sustainable path, and it's not up to us to give them advice.
Do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement. And we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two. Potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate it.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less, equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China a lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the U.S. economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the U.S. economy at risk of seeing the sort of pandemic-era shortages and higher prices if we don't kind of soothe relations between the U.S. and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decision. So the volume of the imported goods increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of the first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories, government, or inventories, government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economies. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right, though. We had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you were monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else, and right now we see inflation kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night, and this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question. Thank you so much,
Chair Powell, Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not. I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a direction, a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
Yo, 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 yo. Yeah, I guess it's not posting the link, huh? Interesting. I'm back inside. There it is. All right. I guess it was blocking it from my other profile. All righty then. So, not June, probably not July. That's what we were here to get the hint. And that was the hint. Yeah. So I covered in great detail the hint, what the hint would mean. What kind of hint? The hint for what? All that was covered in our annual outlook, second quarter update, which we did right before this meeting. Why? Well, it makes sense. So you probably got an email about that. Probably got 5 emails about that, about logging in or signing up. Yes, Sky Killer, what you would do is you would use the Fed Watch tool, or you'd use our risk gauges. Right now, it's uncertain about the response. We have not seen an overall response. So over the next few days, you will see how the market will respond. We're going to look at volatility, the dollar, the stock market, the yen, gold, long-term treasuries, the options market, and short-term treasuries. We're going to look at all of these. Well, yeah, Abdul, I agree. It sounded hawkish, or at least certainly not dovish. But the issue is, how are people adjusting their portfolios? That's the big question. How are they responding to said hawkishness? Well, that's what these gauges are for. That's what the Fed Watch tool is about. And we want to trade along with that. Cool. And that's right. If you are interested in learning about portfolio construction and management, we have a group that manages my pension fund. It's real money. And we're doing fantastic. We're accomplishing all our goals. The way it works is you sign up and you take a training course, which is, 15 hours long, about portfolio construction and management of the stock market, not of Forex, but of the stock market. And then you watch, a 4 or 5 hour meeting about how we constructed our portfolio a year and a half ago. And then you can catch up to our recent meeting in which we just invested $5,000 into an asset. The meeting before that, we held our cash. So I think we were about 30% cash and 30% bonds or treasuries, and about 5% cash right before the crash, the recent stock market. Yeah, which we were prepared for. Yeah, so great. Not a surprise, not a shocker. We were well positioned going into it. Nice. So we are tickled pink. So that's different than trading. This is learning how to be an institutional investor. And I'll tell you, I was just at a conference, a private invite-only conference in Atlanta for basically the 30 top institutional investors in Atlanta. I was one of them. And I think our portfolio kicked butt compared to what everyone else has done during this stress test. So I am tickled pink with the CIA. We are doing fantastic. So anyways, lots going on TRADARS.com. One thing, I guess, if you don't know, I can give you an update. We have a program now that's totally free when you're a member of TRADARS that reduces your spread on every trade. So if you like cheaper trading, there you go. Do we just give you a discount? No, we give you cash. Every day you get some cash placed into your account to make your spread cheaper. Yeah, you're welcome. And we also have a prop fund. Oh, and I needed to tell you something new now. PropAssociation.com. There is a new industry watchdog overseeing the prop trading industry, which I think makes sense, right? Because there's a lot of scummy prop funds out there. And there's also a lot of knucklehead traders, degenerate gamblers. And what we want to do is legitimize the industry so that it remains a strong industry. So we need a good combination of reliable traders and ethical prop funds. I hope you agree with that. So this is a new association, and the team involved are a good group of people that understand the industry. And one of them is me. So I'm now part of the watchdog group for legitimizing the prop trading industry. And in many, 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 many ways, I'm doing this for you. Isn't that cool? Yeah. So if you want to check them out, bing, bada, bing. So have a wonderful day. If you're at traders.com, I'm not going to do a 4 o'clock because it's a half an hour and I've already been talking for 5 hours. So I will see you bright and early, 7 a.m. in the morning, and we will go over the fundamentals of the day. If you are not a subscriber to Forex.Today, if you click subscribe, you will be notified when I start tomorrow's live stream. So please take an opportunity to click the thumbs up button, subscribe, and after I stop the stream, refresh your page and maybe also leave a comment. If this was a good use of your time, please tell YouTube in the comment section, not in the chat, in the comment section, that this was as good as New York cheese. That's pretty good.